All right, let's talk about something that makes the business world go round. Cash. Specifically, how do companies actually get the money they need to run the whole show? It's a world that's absolutely filled with hidden costs and some pretty clever strategies, and we're going to break it all down.
I mean, really think about that for a second. A business has to pay for materials, meet payroll, keep the lights on, and they have to do all of this for weeks, maybe even months, before a single customer ever buys anything. That creates this huge cash gap. So, how on earth do they manage that?
And that's where something called short-term financing comes into play. You can think of it as the lifeblood that keeps a company going day to day. It covers all those immediate costs, making sure the business runs smoothly while it's waiting for its own sales money to come in.
Okay, so if a business is in a pinch and needs cash, like yesterday, where do they turn? Well, the options are a lot more varied and frankly a lot more interesting than you might think. You've basically got three main buckets where this kind of funding comes from. You have your usual suspects, commercial banks, and the financial markets, but we're going to start with the most common source, especially for smaller companies, so-called spontaneous sources. Now, it sounds nice and easy, but as you're about to see, it can be anything but. And that brings us to what I love to call the free money trap. It's a type of financing called trade credit, and on the surface, it looks like a simple, totally cost-free convenience, but it can hide a surprisingly steep price tag.
You know, at its core, trade credit is incredibly simple. Your supplier sends you some goods along with an invoice, and they give you, let's say, 30 days to pay up. For those 30 days, they've basically given you an interest-free loan. It's so common that it's the single biggest source of credit for small businesses. But the devil, as always, is in the details.
Okay, now this is where it gets really interesting. See this little piece of code on the screen? 2/10 net 30. You will see this on countless business invoices. It's a simple deal. Pay us within 10 days and you can knock 2% off the price. If not, no big deal. Just pay the full amount within 30 days. And that simple offer creates a fascinating and very important financial decision.
Because what happens if you decide not to take that discount? What's the actual cost of holding onto your money until day 30? This is where we get to pull back the curtain and find the real hidden cost.
I mean, come on, it's only 2%. For a $10,000 invoice, that's just $200. It really seems like a small price to pay to keep that cash in your account for an extra 20 days, right? Well, let me tell you, the math tells a very, very different story. To figure out the true cost, we have to look at it on a yearly basis. We annualize it. And we do that in three pretty simple steps. First, we figure out the interest rate for that 20-day period. Second, we see how many of those 20-day periods fit into a business year. And finally, we just multiply those two numbers together. This is how we transform that tiny little 2% into a, well, shockingly big annual number. This right here is the key. It's a total mindset shift. By skipping the discount, you are not just paying late. No, you are actively taking out a 20-day loan from your supplier. And the interest you're paying on that loan, it's the 2% discount you decided to give up. So, what does that work out to annually? Are you ready for this? 36.73%. Wow, that's the effective annual interest rate you're paying. To put that into perspective, that is higher than pretty much any credit card out there. All of a sudden, that tiny 2% discount doesn't seem so small anymore, does it? And listen, this isn't just me being dramatic. The source material spells it out clearly. Paying a rate this high is a major red flag. It basically signals that a company is so desperate for cash that it's willing to borrow at an absolutely astronomical rate from its own suppliers. So, if that so-called free trade credit is actually one of the most expensive loans you can get, what's the smarter play? Well, that brings us to the second most common source of short-term financing, good old commercial banks. Now, banks usually have two main ways to help out with short-term needs. You've got your standard term loans, which have a specific end date. And then you have lines of credit, which honestly work a lot like a corporate credit card. You can borrow and pay back as you need to, right up to a set limit. But even here, the interest rate you see isn't always the rate you actually pay. And this leads us to another really critical idea in finance: the difference between the advertised rate, the one they put in big, bold numbers, and the real effective rate. You see, banks have a few tricks up their sleeves to make a loan look cheaper than it actually is. The effective interest rate, that's the number that cuts through all the noise. It asks a very simple but very powerful question. How much did I pay in interest divided by how much money did I actually get to use in my business? That last part is absolutely key. Funds it can actually use. Just take a look at this table. It tells the whole story.
See how both loans start with the exact same stated rate, 8%. But how that interest is paid changes everything. With a simple interest loan, you pay at the end, so your effective rate stays 8%. But with a discounted loan, the bank takes its cut right at the beginning. That means you get less cash in your hand, which pushes your real cost up to almost 8.7%.
So you see what's happening here? It's all about the usable funds. Anything the bank does to shrink the amount of cash you actually walk out the door with, well, that's going to drive up your real cost, even if the interest payment itself stays the same.
And they have other ways to do this too. Check this one out. It's called a compensating balance. A bank might give you a $100,000 loan, but they'll require you to keep $10,000 of it sitting in an account with them, untouched. So you're paying interest on the full $100,000, but you only ever get to use $90,000 of it. And just like that, your 6% loan is actually costing you almost 6.7%.
Okay, so we've seen that free money isn't free, and the bank rates can be a little tricky. It all leads to a much bigger question. How should a company think strategically about all this? Well, there's a really powerful guiding principle that can help. It's called the maturity matching principle. And honestly, it's beautifully simple. The idea is that the timeline of your loan should match the timeline of the thing you're paying for. So if you need cash to buy inventory you're going to sell in 60 days, you should use a 60-day loan. It's just common sense. Don't use a 10-year loan to solve a 30-day problem.
And why does this matter so much? Because when you get this wrong, you introduce a ton of unnecessary risk into your business. If you rely too much on short-term loans for long-term projects, you're constantly having to refinance. You're always at the mercy of the bank, never sure if they'll say yes the next time you ask. The cost of money is one thing, but the risk you take on to get it, that's a whole other ballgame.
So once you understand these hidden costs and guiding principles, it really changes how you look at a business. It's not just about getting the cash. It's about getting the right cash at the right price for the right amount of time. It's a puzzle that every single successful business out there has had to solve. Thanks for tuning in.